Hi everyone, it's Chad back with another video. Today I want to talk about ASML, which just before the market opened announced its results, and they look very strong, but the market has received it relatively poorly. It's down around 4.5% off near 52-week highs. Now it's down to around $728, so way above its 52-week lows. It's up 46% in the past year, around 30% year to date. Over 200% in the last 5 years. It's been an absolutely fabulous investment over pretty much any time period. That being said, on an absolute PE ratio, it's looking rather expensive at the minute and its market cap is very large. So how much room is there to run here? Well, I'm going to talk about that. I'm going to talk about the results and why I think they continue to be strong. Demystify a bit about the current problems with their trade controls and export controls to China. And then talk about whether I think this is a buy, sell or hold for me going forward at these prices. For those who don't know what ASML does, ASML produces lithography machines which are basically used to image patterns onto silicon wafers during chip manufacture. This optical imaging is used in nearly all integrated circuits, and in the most leading edge chips, normally the smallest, where extreme ultraviolet light lithography machines are needed. ASML is the sole manufacturer of these machines, which often go for $200 million each. Extreme backlog, giving this business an earned monopoly and therefore incredibly strong moat, which is why its valuation is so high and why it's such an attractive business. Now for the Q2 results that were released this morning. Net sales of 6.9 billion, that was a significant beat on the guidance. System sales of 5.6 billion euros and installed management based sales of 1.3 billion euros. Gross margin 51.3%, excellent. Slightly lower than its previous one, but still excellent. Operating margin 32.8%, which is absolutely staggeringly good. Net income as a percentage of total sales at 28.1%, very strong. Earnings per share, which also beat significantly, of €4.93. Net bookings of 4.5 billion euros, which again is a beat, and EUV bookings of 1.6 billion euros. Looking at the numbers from the previous quarters to get those quarter-over-quarter and year-over-year numbers, this is obviously a business that's trending in the right direction. 27% growth year-over-year in net sales, 38% growth in gross profit. These are excellent metrics. This is a business that's firing on all cylinders at the minute. Gross margin 51.3%, about average for where it's been for the previous few quarters. Decently up year-over-year. Can't ask for any more really. R&D costs and SG&A costs are obviously increasing, but not at a rate that I would be overall concerned about. I would consider R&D costs increasing a net positive really. Lithography systems sold 113 compared to 91 the year prior. This is its best performance for many years. One thing that I think has caused the decrease in the price of this stock today, which is around 4.5% down despite increasing guidance and excellent results, I think is the net bookings being down. You see 8.4 billion of net bookings this time last year, now just 4.5 million. Now that is a significant increase over Q1, and there's some degree of seasonality, but I think a lot of this is just panic by the markets. I don't think this is something to be concerned of. There are capex cycles in these type of businesses, and I think net bookings will go up and go down. It's definitely something that to be mindful of. I don't want to see net bookings this low for many quarters, but this is an extremely strong business with an excellent moat, and if companies need the EUV lithography machines or lithography machines in general, there is really only one company to go to, and with the tailwinds behind the semiconductor industry, I can't see net bookings staying this low in the intermediate. I simply think that with the economy tightening, there's been some tightening on capex cycles, so I don't have that much concern here, but it's definitely something to look at future quarters at. I think the export controls to China has been widely misreported, as we can see in these net system sales. It's up year over year, as you would expect. Region ship location is what I'm looking at here. In the previous quarter, it was 49% to Taiwan, as you would expect. That's Taiwan Semi. South Korea 26%, that's Samsung, and just 8% to China. This quarter, it was 24% to China. Now, the export controls means that no extreme ultraviolet lithography machines will be allowed to be exported to China. They are used for the manufacture of the most leading edge chips. Older equipment, essentially all the other four in that list, they can be sent to China, and they're exporting them in mass quantities. It looks like 49% of the technology was RFI and only 37% EUV in this quarter. So this is kind of the seasonality effect, the capex cycles effect. These are extremely large machines. Some quarters, Taiwan Semi will buy a ton of EUV machines. Other times, some Chinese companies will buy a lot of AR5 machines. This is to be expected, and I think I'm quite happy with how this business is performing. And while the export controls will hurt this business in the future perhaps, I can see resolutions to this in the future, and I can also see this business being just fine without it and it just slowing its growth down slightly. But it has revised up its guidance from 25% to 30% revenue growth for the year, so I'm not so concerned about it. After 2 quarters this year, the total net sales to this business look absolutely excellent. It's already nearly outperformed the previous 2 years in logic already, and we're only halfway through the year, and this business is on track to do something like 28 billion euros in revenue, and it's a lot more in logic than it has done in previous years, with installed base management and memory looking like about the same, if memory slightly down. The guidance going forward looks extremely strong. Net sales between 6.5 billion euros and 7 billion euros. Install management base going up to 1.4 billion. Gross margin maintaining around 50%. These are extremely bullish. And for 2023 overall, they expect the net sales growth towards 30% with slight improvement in gross margin relative to 2022, so probably around that 50% mark. This is a significant increase over the 25% guidance it had previously given, so I can only imagine that the stock slide today is due to perhaps valuation, more likely the net bookings decrease. This business also has an excellent track record of returning capital to shareholders. Since 2014, it's returned over 25 billion euros of capital to shareholders in the forms of dividend and share buybacks. The dividend, while paying only a little over 1%, has grew dramatically since 2014. 2014, it was just 70 cents a share. In 2022, it was €5.80, so that's an 8x increase in 8 years. An absolutely ridiculous amount of dividend growth, in my opinion. This year, so far, the interim dividend was just 1.45. The final dividend is often significantly larger. In Q2 2023, they purchased around 800,000 shares. Not a significant amount by any means. It's only 500 million euros, so a fraction, with a market cap of nearly $300 billion at the minute. But it's definitely not to be sniffed at, and they do have a strong record of buying back shares. The share count has steadily reduced from around 440 million shares outstanding in 2014 to 8 years later, or 9 years later now, to be around just under 400 million. Now, this isn't staggering by any means, less than 1% a year. However, crucially, it is going in the right direction. Shares are very rarely issued, and when they are, it's for important reasons. It's only really happened in 2017. Over time, the share count is going in the right direction and at a reasonable rate, but the capital is returned to shareholders mostly through dividends, and they do that frequently, and it is growing rapidly. Obviously, a business like this is going to command a premium valuation as one of the widest moats in the world. It is essentially a monopoly. It has enormous tailwinds behind it in the growth of the digital economy, the semiconductor industry, the growth of AI, blah, blah. Everything needs chips. And it also has an excellent dividend growth track record. It's growing at 30% this year and returns capital to shareholders on a regular basis. Of course, this is going to trade at a significant premium to whichever stock exchange that it is on. That is currently the case. Currently trades for around 39 times trailing earnings. That's significantly higher than the index, but below its 5-year average, which is admittedly very frothy at 41.5. Price to cash flow around 27, which I would consider expensive. Not necessarily for this business, but on an absolute basis, 27 times free cash flow is expensive, but it is below its 5-year average of 35. And on a forward earnings basis, it's right in line with where it normally is. For an earnings yield of 2.5%, that is not perfect by any means. This is not a cheap stock. However, I can't see a period where this ever will be cheap. I picked up some shares in 2022 on a rare dip. I think I'm quite happy with my buying position. I don't think I'm going to be buying any more at the current prices. However, hopefully this sort of the panic over the China export scandal, or not scandal, but the panic over the China exports is going to bring the share price down a bit to a more buyable range. I'd be much happy paying 600 or less for this business, which is kind of what I was picking it up for in 2022. Of course, this is just my opinion. I'm not a financial advisor. You should let me know what you think in the comments down below. You should also contact a registered financial advisor if you feel in need of the advice, and do your own research and due diligence on your stocks. Capital is, of course, a risk at all times. I am by no means saying you should buy, sell, or hold this business. This is just my opinion on what I think is the best course for me. Like and subscribe and enjoy the videos. Comment down below, tell me what you think. I'll see you again next time.